Very good. Well, thank you very much for having me on the call. As Deborah mentioned, I have just published a paper kind of looking at what's been happening with the PACE programs that are already in place and kind of what the lessons learned are from those programs. So I'll give kind of a brief overview of that, but talk more importantly about kind of the importance of state policy design in terms of setting up these programs. As just a little bit of background, I'm with the Institute for Local Self-Reliance. We've been around for about 35 years, based in both Washington, D.C. and Minnesota. And the New Rules project that I work on is focused on, as we say, making rules as if community matters. And so municipal energy financing has been something we've been very interested in for the last couple of years, following the developments and kind of the early programs, and then being very interested in how the programs have been evolving and expanding across many different states. So if we go to the next slide here, I'll talk a little bit, just kind of the overview of my presentation. I'll start off again with just a quick overview of where the Property Assessed Clean Energy or PACE programs are so far, the programs that are operating, what they've accomplished. I'll talk about kind of one of the most pressing issues for PACE right now, which is this lender letter from Fannie Mae. And then I'll talk about some of the things, primarily from the paper that I've written about policy design, kind of what are some of the important things that need to be considered in setting up PACE-enabling legislation and then in setting up the programs themselves. I'll talk about lending guidelines that the White House has put together, talking about the importance of aggregation for putting together financing, this kind of debate between the minimum requirements in terms of energy efficiency and maximizing participation in PACE programs, and then also a little bit about technical assistance, which was already mentioned previously. So on the next slide, I'll just get started with this overview of PACE status. There are now 20 states that have legislation enabling PACE programs. There are a few in blue there that had laws on the books prior to 2009 that allowed for the development of PACE, but most states have recently passed enabling legislation. And there are 4 programs that are currently operating that have kind of a decent enough history for us to evaluate how they're doing. 2 in California, in Palm Desert and Sonoma County, 1 in Boulder County, Colorado, and 1 in Babylon, New York. And between these 4 programs, about $40 million has now been spent on energy efficiency retrofits and on-site renewable energy generation, and that money has improved or very close to 2,000 properties. If you're interested for more overview on kind of where those PACE programs are and some of the lessons, again, you can check out the paper that I've written. The link there is on the bottom of the slide, and will be at the end of my presentation as well. So on the next slide, then, I'll talk about this Fannie Mae lender letter that came out on May 5th. This is a quote directly from the letter, and it talks about how PACE loans generally have automatic first lien priority over previously recorded mortgages, and that the terms of the Fannie Mae Freddie Mac uniform security instruments prohibit loans that have senior lien status to a mortgage. And there are kind of there are a couple different issues that this lender letter raises for PACE programs, but the biggest one is this use of the term loans. Fannie Mae is basically saying that rather than being seen as an assessment like a street assessment that would be assessed for the public benefit, that they see a PACE improvement assessment as a loan, like someone might get from a private bank. And this raises, of course, issues then with the seniority of that loan compared to their mortgage. And so I'll talk here on the next slide about kind of the 3 lessons that we can take from that lender letter. And again, if you want to see the full letter, I've got the URL provided at the bottom of the slide. The first lesson is that it's very important in state enabling legislation that PACE is clearly defined as a special assessment. In many states, this means that it will be, as special assessments often are, already senior to whatever the mortgage is. But it's very important to have that definition in place. Really, when it comes down to it, that seniority is the key to getting to allowing municipalities to issue bonds that there will be any kind of market for. If the assessment for PACE is not senior to the mortgage, it's going to be sort of even lower on the totem pole than some of those collateralized debt obligations and things that created our credit crisis. And so the seniority of the assessment is actually very important, and therefore it's very important in the enabling legislation that PACE clearly falls within those categories. The second piece that's kind of key to this, and I didn't mention on that letter slide, is that PACE assessments should be clearly identified as a public benefit. This was actually one of the very successful things that was done in the Babylon program and in their enabling legislation. They are using, kind of in a unique fashion, tying PACE to their solid waste assessment. And they did that by defining carbon emissions as a solid waste and saying that the PACE program and the energy retrofits and the energy savings and the reductions in energy use are of a public benefit because they reduce carbon emissions. And so that public benefit piece is actually very important because that's what really ties PACE into kind of prior assessment authority. We did street assessments because the streets are kind of a common area and of common benefit to the properties around that street. If PACE is seen as just an improvement for that personal property owner and for their own benefit in terms of energy savings, it's not going to be as clear to lenders why this should be a senior lien as opposed to being a private bank loan. And I think the third lesson from the lender letter is just that we should make sure that programs that are established in our states are operating under due diligence, and that it would be certainly within the policy framework of a state to require programs to adhere to those White House guidelines for program design, which I'll talk about a little bit later. So we'll go on to the next slide then, and I'll talk about kind of the four components of policy design that we've kind of learned about from the existing PACE programs. Again, the lending guidelines from the White House that I just mentioned, this issue of aggregation, minimum requirements for energy savings versus maximizing participation, and then kind of where programs and folks can get technical assistance. So on the next slide, then, I'll talk about these lending guidelines. The White House issued a very nice framework for how PACE programs should set up their lending guidelines to be pretty much the most responsible, but then also to increase their chances of getting better credit ratings on their bonds that they would issue and therefore lower interest rates. Again, I've provided the URL if you want the details from the full White House framework. But it's essentially broken down into two categories. One is that we should finance good projects. One of the guidelines is that the energy savings from a PACE retrofit should exceed the assessment costs. This is also called a savings to investment ratio. The second one is that we should finance high-value improvements, that we shouldn't just stop at caulking windows and putting in weather stripping or other minor things, that PACE is an opportunity to really go deep and pursue retrofits that are more expensive, have a longer payback period, but therefore have a commensurate higher energy savings than we might be able to get, particularly in comparison to private financing, which might be available on a shorter term and comparable interest rates for things that already pay back very quickly without PACE. And the final important piece about financing good projects is that when we do projects and retrofits, that they should be verified, that somebody should come by and make sure the work was completed as described and that it is actually accomplishing those energy savings that we were promised. The second component of the White House framework is kind of this idea of good fiscal practices. You see that in terms of municipal assessment reserve funds to both assure that the municipality would not have to resort to general property taxes in the event of defaults, but also in making sure that the municipal bonds that are issued to finance the program are attractive to investors. That assessment terms should not be less than the improvement life expectancy. In other words, we shouldn't be providing 50-year financing for 25-year life solar panels. That we shouldn't finance properties in default, and that we shouldn't finance properties where the mortgage is greater than the assessed value, in other words, underwater properties. So I think the White House framework provides some good guidelines for what can be put into state legislation to make sure that programs are set up to be the most fiscally responsible. So go to the next slide then, and I'll talk about this issue of aggregation as a second component of good program design and good policy design. This really gets to the issue of enlarging the bond pool. And really, when you are considering how communities are going to raise the money, aside from getting stimulus funds to kind of kickstart their PACE programs, municipal bonding is where that money is going to come from. And the larger the region in which you're bonding, whether it's state or a region or a county, rather than just a city, kind of the more advantageous your situation will be. And you've got a few examples of that. Boulder and Sonoma are county-run programs rather than just city programs. California First is going to be leveraging an existing community of kind of bond pooling by allowing over 100 municipalities to do PACE bonds. through that process. It's a structure that's already been set up to help pool municipal bonds. And Colorado has a proposal, House Bill 1328, that would create a statewide PACE program where the bonding would be done on the state level. And the importance of this is that when you have aggregation, you get greater diversity in terms of the properties that are involved. Therefore, you also have more properties participating, so you have a larger bond issue. And this translates into lower risk for the buyer of those bonds and often lower interest rates. I've had some conversations with folks who are bond buyers, and they said essentially, if you're not talking about, several $1 million in a bond offering and over 500 properties that are from a diverse region of your municipality, then it's going to be very difficult to get investment grade rating on your bonds. And to get a sense of how that's working, you can look at Boulder County, for example, has been able to get interest rates just under 7% for their first couple of bond issues. And so it's going to be worthwhile taking this back to that issue of state policy design. Make sure that counties can gather together to do a bond issue as a group. Make sure that municipalities can gather together and do a bond issue as a group, because they're more likely to be able to get favorable terms if they're able to do that. So on the next slide, I'll talk about this kind of debate that's going on among some of the PACE communities. I should mention there's this excellent listserv that's being operated by Marion Fuller at Lawrence Berkeley Labs in California that has a lot of the folks who are running PACE programs on it, and the conversation there is very high level in terms of its addressing the issues that are coming up in the development of PACE programs with folks who are currently administering those programs, being available to answer questions for those who are interested in setting up programs. But one of the debates that's been going on there is this issue of participation versus savings. Can we set up strong guidelines for PACE programs? That for example, people have to save at a minimum 10% or even 20% in order to access financing. Or are we going to say that our goal is to really get as many properties to participate as possible, and we don't really want to set too many guidelines and make it too difficult for folks to participate? And so the issue is, are we going to be satisfied with a lot of folks participating and maybe not doing very much? Or do we want to really distinguish this program from, for example, what folks could do with private financing and require people to go deeper? And on the next slide, I address kind of the range of options that you have. Kind of on the lowest end, the highest participation and kind of the minimal requirements, you have, as an example, Boulder County, Colorado. And I should say this is previous to them receiving some stimulus funding where they are going to have some higher requirements. But right now their basic requirement of participants is simply that they have to spend at least $3,000. You can see a step up from that is having a kind of a minimum energy savings threshold for participation. California programs that are going to get funds from the California Energy Commission participants must achieve an energy savings of at least 10%. You also have kind of another step up from that. This is being seen in Babylon, New York, that the thermal envelope has to be sealed on the property before you can get funding for solar. And so this isn't necessarily a minimum requirement of participation in the program, but it says, hey, if you're interested in the solar, kind of the sexy selling point of a PACE program, then you have to at least get your house in order in terms of not leaking energy. And it has to do with both making PACE a good investment for the property owner, making sure that their on-site renewable energy generator is not oversized for what the property needs, but also making sure that the program funds are being spent responsibly on things that have the greatest energy savings. Another great example of this is the Montgomery County, Maryland program, which requires either a 25% energy savings or homes to reach the EPA Home Energy Yardstick score of 7.5 on a scale of 10 before they're able to invest in solar. So these are some really good requirements to make sure that program funds are primarily devoted to things that are sort of more bang for your buck in terms of both energy savings or reducing carbon emissions. Another option that could be used in terms of setting up a program would be to require properties to participate in getting a retrofit done, maybe when the property sells, and that these properties would have to achieve a certain efficiency savings, and that the PACE program would provide the financing for it. Nobody has this kind of program set up, but it's one one way to really maximize the energy savings that you would be able to accomplish under a PACE program. So these are kind of 4 different ways that programs have so far kind of set thresholds for increasing energy savings, and I would strongly consider, in terms of state policy design, that some sort of minimum requirement is established, in part because what this does is set PACE apart from private lending and says, this is a program to help cities, counties, and the state meet energy savings goals rather than just a program to help people pay for doing energy efficiency improvements, which is what can already be accomplished to some extent with private financing. So on the next slide, I'll just briefly talk about kind of where folks can get technical assistance. At the Institute for Local Self-Reliance, I am available to answer questions. Certainly have a look at our report if you want some more information about the municipal financing programs that are out there. I keep very tuned into the listserv and the conversations that are being had, and try to do some extra research on how programs and state policies are addressing some of these bigger issues. The Lawrence Berkeley Laboratory also has 2 excellent people, Marion Fuller and Mark Zimring, who are working on these issues. And as was mentioned at the beginning of the call, that there's going to be free technical assistance to programs that are launching with retrofit ramp-up stimulus dollars. And so those are 2 places where you can find some good help. But again, the listserv that Marion Fuller runs at LBL has a wealth of information on it with the various program administrators of PACE participating fairly actively in it. So for my last slide, I just want to say thank you again very much. If you want more information about the New Rules Project or about the research that we've done, again, the link to that report is at the bottom there. And I'm certainly more than happy to answer questions today and by email if you have any follow-up questions that we can't cover today. Thank you so much.